Welcome everyone to what I think is our 8th Taste of Techstars Sustainability, our final one before our last one, which will just be Q&A. So it's our final content one, and we're super glad to have you joining us today. I'm Hannah Davis. I'm the Program Director for the Sustainability Accelerator, and super excited about our session today, which is going to be around understanding investor perspectives. For anyone who's joining us for the first time, super quick, Techstars is a worldwide organization that helps entrepreneurs succeed. We do this by running mentorship-driven accelerators. And I'm lucky enough to work on the accelerator that partners with the Nature Conservancy. And so I'm going to hand it over to my counterpart, August Ritter, who works for TNC on this accelerator, to talk a bit about that.
Hey, thanks, Hannah, and thanks everybody for joining today. Yeah, just really quickly, many of you probably know who the Nature Conservancy is. We're the world's largest conservation organization. We operate in over 79 countries, and we've got 4,000 staff around the world, really trying to solve, the food, water, and climate challenges that our planet faces. But we recognize we can't do it alone. We recognize there's a lot of phenomenal partners out there who are trying to solve the same problems that we care so much about. One of the things at TNC that I'm proud that we've really taken into account is how do we leverage kind of the financial mechanisms that are in place to get more money flowing to the people who are building the solutions to these problems? We've done that with an initiative we partnered with JP Morgan on called NatureVest. We've done that through different conservation initiatives like Debt for Nature swaps or our water funds. One area we hadn't really looked at was the kind of tech entrepreneurial ecosystem. Until a couple of years, we recognized that a lot of the technological development that was happening in the world wasn't necessarily happening to solve the problems that we at TNC believe are the greatest problems to humanity. And so we asked ourselves the question, can we play a role in helping catalyze more investment into the technological entrepreneurial ecosystem to the people, to the entrepreneurs, to the founders who are building technology to solve these problems? And we weren't really sure, but we decided it was worth giving it a shot. And that's really what was the genesis of this partnership with Techstars, was the Sustainability Accelerator, to essentially see, can we help prove out the business case so that we can get more and more investors putting money into the space, particularly towards the founders that are building technology to solve our food, water, and climate challenges. And so I believe many of the folks that are on the call are doing that today, and I'm just super grateful to you. I'm really excited to hear the perspective of the investors that we've got on the call. Thank you to them as well. And keep fighting the good fight. As we've all seen here with the COVID-19 crisis, the world can mobilize into a solutions-oriented mindset rather quickly when the appreciation, the recognition of the crisis at hand comes to bear. So, with that, maybe Hannah, I'll hand it back over to you, and thanks everybody for your time again today.
Awesome, thanks, August. We love working with the Nature Conservancy, and it's been a lot of fun. We've run 2 programs, and right now we have applications open for our 3rd. So without further ado, I'd love to turn it over to our special guests today that we're so lucky to have, and have you guys introduce yourselves. So if you could start by sharing, who you are, what organization you work with, kind of what type of investments that organization makes. So anything that will allow entrepreneurs to better understand your perspective. What's your average check size, kind of a quick overview of your investment thesis, and maybe an example of the last investment you made. That was a lot of introduction questions, so if you forget, I can remind you. Victoria, do you want to start us off?
Sure, happy to start, and thank you, Hannah and August, for having us and for the great work that you all are doing in partnership. You're a really important part of the ecosystem, so glad to be a partner and glad to be here today. My name is Victoria Beasley. I'm a partner at Prelude Ventures. We're based in San Francisco, and we invest broadly across the low carbon economy. So for us, every investment we look at, we have to be able to check the box and asking ourselves at scale, does this company have the potential to meaningfully reduce greenhouse gas emissions? So a very specific mandate. We pride ourselves on looking broadly within that to assess what fits within the climate space. So within our portfolio, we have about 45 companies. Certainly we have a core in energy efficiency, renewables, energy storage, all things energy. But we've also done a number of things in food and agriculture. transportation and mobility, advanced materials, advanced manufacturing, advanced computing, apparel, and circular economy. So it's really for us about, again, can we make the claim that at scale these companies have the potential to reduce greenhouse gas emissions? We've been around since 2013, and we're structured as an evergreen fund, which just means that we can continue to invest kind of rather than in a fixed fund. We can invest perpetually, and what that means for companies is that we're able to grow with the needs of the business. So it's not uncommon for us to invest at a Series A and continue participating at or above our pro rata into subsequent follow-on rounds. I would say we are a true venture investor in that we typically invest our first check at a Series A or Series B. Occasionally we'll go a little bit earlier and occasionally we'll go a little bit later, but that's kind of our sweet spot. In terms of our average first check, there's a range, but generally 3 to 7 is sort of the 3 to 7 million is the tighter range. And again, we'll go as early as a seed deal where we'll put in, 500K, and we can go into later stage companies as well, writing checks in the tens of millions of dollars. I kind of explained our theses. My background also spent a little bit of time in agriculture. And then when I joined Prelude 4 years ago, we hadn't done much in transportation and mobility. So I've spent in the last 3 years kind of a disproportionate amount of my time developing our theses in that space. It's obviously a massive space with many kind of subsectors within it. The last investment I made that's been announced, to your question, was in a company called Optima Route, led their Series A. And they're ex-Google and Yelp folks who are really good at algorithms at their core. That's sort of the core innovation. But the product is serving the long tail of small and medium businesses to help them route in the most efficient way their operations and last mile. So anyone from doing laundry delivery to food delivery to HVAC servicing, that sort of thing. Doing interesting work, and it's one of those parts of the economy where lots of vehicle miles are traveled, but not necessarily paid attention to from an investment standpoint. So that's a little bit about me. Hannah, let me know if I missed anything. Again, delighted to be here and glad to be here with Eric and Jason.
Thanks, that was perfect. Hit all the points there. Eric, we'll hand it over to you for a quick intro.
Thanks, Hannah. And Victoria, I think there's a ton of overlap, as we know, so I won't have to bear too much repeating, but I think you're getting a flavor of what our investment appetite is on this call. So I represent the Grantham Foundation for the Protection of the Environment. My name is Eric Smith. I'm an investment officer. And we actually represent 2 charitable entities, and one is a foundation, which is governed by the family, and one is a trust, which is governed by an independent board of environmental NGOs. We represent a long-term patient capital perspective. So we invest directly from our corpus, and I handle direct investing, which is a different business than our manager selection and how we choose and allocate our principal to third-party venture, private, public fund managers to invest our corpus. With that long-term patient perspective, we are the direct investing that we do does have a mission-related perspective. So we are looking for impact as a driver and is fundamental to our thesis, but we're always looking for fundamentals in terms of market, team, and product fit anytime we're looking at a deal and making direct investments. Within, without going too specifics, we have a mission-related investing vehicle we like to call Neglected Climate Opportunities. It is our kind of impact-first investing vehicle whereby we're investing in 4 to 5 thematic areas that we believe have the potential to accelerate carbon abatement opportunities. The thesis is on kind of the low-cost abatement as measured in $1 per ton. The thematic area is underinvested, has low capital flowing relative to other carbon abatement opportunities. So something like traditional power or battery or some mobility stuff, we tend to stay away from because we think there's plenty of commercially oriented venture capital that's attracted to those deals. And the thematic areas tend to be underappreciated. They fall within a kind of a gigaton reduction strategy bucket that we think is really important for helping to move forward. So our 4 initial thematic areas that we ended on were kind of soil, carbon, and land use, and that includes a lot of ag tech type stuff, oceans and seaweed, reducing methane from oil and gas operations, and then the carbon removal, utilization, and storage bucket. So 2 biological approaches and 2 mechanical approaches. And then we have a kind of a 5th one we're adding, which is the synthetic biology space, which includes a lot of fermentation and kind of carbon to value type approaches. Average check size, so that represents a very specific opportunity that we've defined, but we also do plenty of direct investing off the balance sheet in other very interesting deal by deal thematic areas. Average check size for us tends to be about $1 million, $1.5 million, and we tend to go a little bit earlier than Prelude and Victoria. So we like to play in the kind of pre-seed, seed, Series A, and then we like to keep a lot of, as you call, dry powder to help follow and incubate these companies along their development curve as they grow. And that perspective is really important in being able to stay with a company for a long time, which is, I think, is a unique insight you're getting on this call today in terms of what type of capital to look at. Check sizes have ranged from 100,000 all the way to 5-6 million, and maintaining that long-term support as long as conviction remains that the business is strong. Recent deals, we've recently closed on 2 kind of carbon capture technologies. One is called Verdox, based in Mass, that uses an electroabsorption technology. The other is a company called Carbon America. They do, it's a flue gas capture technology using cryogenic capture and storage. And then on the biological side, we just closed a kind of a bridge financing for a company called Land Life. It's a reforestation company. And we're very excited to announce in the coming days a deal we closed with one of the Techstars sustainability teams that came out of the cohort, which will be announced shortly.
Awesome. Thanks, Eric. Over to you, Jason.
Hi, Hannah. Can you hear me okay?
Yeah, good to see you. Thanks for being here.
I'm so sorry. I was a couple of minutes late. I had some technical difficulties, but very excited to be here.
All good.
Hi, Eric and Victoria and everyone else. So yeah, I'm Jason Jacobs. I am by far the least experienced representative on this panel. I was a longtime technology entrepreneur. I built a fitness app company called Runkeeper, so nothing to do with climate change and sustainability, but was the founder and CEO of that for almost a decade. And we had a bumpy ride with a happy ending. We were acquired by ASICS, the shoe company. I ran digital there for a couple of years and saw through the integration post and succession post acquisition, and took some time off. And I've spent the last year and a half doing a deep dive into climate change, and kind of came in as a learner and started having tons of discussions, which led to a newsletter, which led to a podcast called My Climate Journey, and now a Slack community and some other stuff. But I've been using angel investing really as a tool to help get up the learning curve over the last year. So I've done, I think, 13 climate investments, small checks, so 10K or occasionally a 25. Although I did my first syndicate where I put in 150 last week into a company that I was an initial angel in that raised a follow-on round. So I'm starting to do some bigger checks and thinking about how to pool some capital to do more investing with bigger allocations as the investing is getting ramped. But historically, it's just been kind of as a learning tool. So it's been anything from like Project Wren, which is a company that does consumer offsets, or Pachama, which is a reforestation marketplace, Scoot Science, which is they do forward-looking analytics and monitoring around ocean data, and they're coming out with insurance products initially for the aquaculture industry, but ultimately for other areas of the ocean economy. But also a company called Wright Electric, so an electric jet, carbon engineering, doing direct air capture, Opus 12, converting carbon to car parts and other valuable products, a company called Sinai Technologies that is building a software platform that helps big companies monitor, improve, and report on their carbon footprints. So kind of a generalist, but as I think about scaling the investing, I think it's more about probably staying away from companies that are science projects or companies that require hundreds of millions in project finance that require future policy changes. Not because I think those are bad investments, but just because they feel like areas I understand less and have less control over, and probably doing more of what I do understand, which is stuff that can be more capital efficient, but ideally capital efficient, but helping facilitate the moving of atoms so they can have a big impact on climate.
Awesome, thank you. And I don't know how much longer you can say you're not that experienced, since you've been in this deep dive now for almost a year and a half.
Well, I wouldn't call it a deep dive, though. It's been like a thin and broad dive. So maybe that's why I say I'm not that experienced.
A wide dive.
Really broad.
Exactly.
Yeah.
Well, awesome. That was super helpful context for kind of the conversation today. So one thing we always, encourage our entrepreneurs to do is understand, why they're raising money, from who they're raising it from, and make sure there's alignment with the company, their goals, and their investors. And so I think a key part to that is kind of understanding expectations from where the capital is coming from. And the reason we wanted you three is because you all kind of represent different perspectives in the ecosystem. So I'd love it if you could kind of share your perspective around when a startup is looking to get investments from your organizations or yourself, what are your expectations? So whether that's, board seats, time horizon, kind of like, what are the hidden things that would be helpful for startups to know as they approach you for capital? And does anyone, Eric, you're nodding your head a lot, so let's start with you.
Expectations. So I think this goes without saying, but having a long-term commitment, and you're really ready for this to be the next 10 to 15 years of your life, and you're not looking for a quick exit and a quick buck. We're not that type of capital provider, and so I should say that there is every flavor of capital out there, and it sounds like VC is a bucket, but really there's incredible diversity of expectations in terms of trading equity for a partnership. And so having that long-term perspective is really key, and that's what you're getting with this long-term partner. One of the things I keep hearing is working with venture capitalists is like signing the divorce papers while you're getting married. It's not easy. There's always going to be a lot of tough conversations and turbulence at the beginning of a new relationship, and working that out from the get-go is really key. And that's where you're finding if you're compatible with your partner who wants to be there for a very long ride, a very long, successful ride, hopefully. So our expectations are really, it's kind of an inverse relationship. So earlier in the funding cycle, we expect to take a larger role and a larger outsized influence because you're earlier in your development cycle, and that's the type of place where our capital can take that risk. But as you move forward, we're really helping you to think about how to syndicate and how to bring new investors to the table and move through those milestones to demonstrate to new funding partners that you're ready for more commercially oriented capital. So my expectations change along your development and your funding curve. But depending on where you're at, it's going to be a very different conversation. And so I'm going to play a very different role in a later stage series A, B, C than I would if I'm looking at pre-funding, seed, even some series A stuff. So those expectations change constantly. The other thing I would say is that the expectation is that, your venture is like, it's like throwing gas on fire. So you need to understand that it's like you have a commitment to going fast and going fast in a meaningful and structured way. And if that's, again, not something you're thinking about or ready for, then that's not the type of partner you want to take on that has that expectation for really growing quickly. I'll stop there.
Great, thanks. Victoria, how do you guys differ or similar, and kind of what else would you add of expectations Prelude has?
Yeah, sure. Definitely a lot of similarities there. I would say to kind of complement some of what Eric shared, we do have an expectation of market rate returns. And to Eric's point about there being a spectrum even within the climate venture community, however we want to describe it now, there's a spectrum of folks who are more oriented towards impact. There are folks who are more oriented towards returns. The hope, right, is that there doesn't have to be as much of a trade-off. Our own perspective, and it's just one, and I, have so much respect for folks who have other perspectives along the ecosystem. I think it's important for us to all exist. But our perspective is that if we're going to solve climate change, we need to get solutions to scale. And doing so in the capitalist environment that we work within, for us means, can we get to helping a company or investing behind a company that is able to make money, be profitable, and continue to grow their business. So that's how we think about aligning impact and returns for us. So very specifically, that is an expectation. Having said that, early on, especially, the things that I look for are, is there a big enough vision? So to Eric's comment, this is going to be probably a decadal relationship, even in a great outcome. And so backing teams who understand that and who are in it for the long haul, and have a vision to get to the long term, a big vision, big market, big impact, is essential. And then the corollary to that, especially at the early stage, one of the things I look for is an understanding, really crisp understanding of, if I'm going to raise $10 million, I know exactly what that $10 million is going to do for me in the next 2 years. And there's a discipline in that and a communication skill in that. But I think the folks who I've seen, do quite well, especially taking on venture for some of the first time or early in a company, have a really clear articulation, not only, again, of the long-term big vision, but also the incremental steps to get there with each round of funding.
Thank you. And Jason, I think it's that the angel kind of is a whole, you don't have LPs, for example, that you've raised money for necessarily. And so kind of how does your lens and expectations similar or different than what Eric and Victoria talked about?
Well, I think it's a whole different sport. As you said, I especially if I look backwards, it was more as a learning tool where I was writing intentionally small checks and just trying to get closer to the action. And so the criteria over the last 12 months was just if I found great teams that were tackling potential big areas for decarbonization that had some smart institutional money either around the table or coming in alongside of my check, because I just didn't have the domain expertise nor the cycles to do the type of diligence that a firm, like a Grantham or a Prelude would do. And I was looking so broad as well that I just didn't have subject matter expertise anywhere. Looking forward, that's starting to shift where, and some of it also is that I think with my climate journey is starting to shift where I would call the 100-something episodes of the podcast was kind of the intro course, where now it's about kind of finding key themes and digging deeper and getting to know them better, which means that I can start to be more of a conviction investor going forward, but I'm still kind of working my way through that transition. But stuff I look for is, most important for me, it's team, it's area of focus, and do I think it's an interesting market? It's, do I believe in the approach or kind of the wedge that the company's going in with and the vision of what they're trying to create? And do I believe that there's strong founder market fit? And are they showing good evidence early on of, even if they don't, it might be pre-launch, but are they showing evidence of their iteration cycles, of their process for experimentation, of the crystallization of their thinking? How adaptable are they? How well are they executing? Is the team firing on all cylinders together? are they talent magnets? Do they have ability to attract talent? Are they clear communicators? Do they tell compelling stories? Do I get the chills when I hear them talk about their vision for the future? So it's much less kind of thesis driven and more about people, but it's like I'm still trying to articulate it, but it's like I know it when I see it.
Yep, that's super helpful. And Techstars talks about our investment thesis is team, 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 product market fit. And there's a reason team is the first three things. Eric and Victoria, do you have anything to add around kind of what stands out around great companies and founders? I think that was a lot of great specific examples there. Jason, I don't know if you guys have anything you want to add.
I would actually harken on Victoria's point about the ask. I can't tell you how many pitches I get where they are not sure about what type of capital they're asking for or not sure how they're going to use the proceeds. And being clear about what your milestones are going to be and what your expectations are for how you're going to advance along your development curve is so key. And it builds on Jason's point in that you're pitching, it's a sales pitch, and being so clear and communicating well through that to really articulate your point. If you can't do that, you should have a team member that can do that, or look to find training to help you to do that, because it's an unfortunate side aspect of the game. But if you can't articulate your vision and how you're going to put it to work, you're not going to get a lot of traction.
The only thing I would add is just echoing, what you were saying about Techstars' perspective, and Jason and Eric, but team is paramount. I mean, it's foundational to all these other points. So it's hard to get around that. And I think, within that, it's communication, it's founder market fit, it's passion, it's, ability to attract others around you. It's all of those things, but the team part is foundational. There's no question.
I think one thing for me, it's a subtle thing, and it's one that candidly, when I first started out, I didn't do, but that I look for in founders now is being humble about being clear-eyed about all the things that could go wrong, and having an intelligent discussion about it as a partner, as if you're on the same side of the desk as the investor, versus just trying to steamroll and convince them that it's going to happen no matter what. It's a fine line because you want to convey inevitability, but if someone, tries to brush off competition and tries to brush off, market factors and regulatory risk versus saying, hey, here are the things that could kill us. So but here's why we think it's a smart bet and we're devoting our lives to it. And here's the world in which this gets really big, but we don't have a crystal ball. Any number of things could happen. It's I find that type of discussion much more compelling than trying to pretend that you can predict the future.
I'll just pick up on that and just tackle it just quickly. I agree, and I think sometimes, especially first-time founders, don't necessarily appreciate that investors are taking risk and they're okay taking risk. And so I would just share, when we write investment memos, we have a list of 8 or 10, depending on the company, risk factors, and we for ourselves, for creating disciplined thought, and also to give us something to look back on, we very clearly say, okay, team, we feel less of a risk, technology, more of a risk, regulatory risk, not a risk. And it's okay to have some of those that are flagged as risks. To Jason's point, I think being able to articulate and say up front, these are risks. This is what you're taking a bet on. It's okay to have some of that, so long as you have a plan for how to mitigate and folks are clear about where the gaps might be. It's okay. Folks are trying to create something that doesn't exist yet. Of course, there are going to be some gaps.
Yep, that's a really good point. One thing I'm curious about too is, so putting myself in the shoes of a founder, kind of what will change for entrepreneurs after they start taking outside capital? Does it change kind of how they're growing their business? Does it change kind of, who's in charge? Can you talk a little bit about what you've seen and how you like to think about it through your lens of investment? Whoever, go.
I can take it from an entrepreneur perspective.
That's what I was thinking, Jason.
Yeah. I mean, what I find is, and I mean, investors feel free to tell me that I'm thinking about it wrong, but that, I mean, the investor's job is as board members, it's to set strategy as a board and to make sure that there's the right CEO, but otherwise it's the CEO's job to run the company. And if the investor is getting too involved in the day-to-day, it's not sustainable and probably means that there's a problem. Maybe some investors like to, and so if there's a stated partnership with a different model than that, then maybe that's okay. But in general, I think that the investors don't want you to ask them for permission. They want you to have conviction in knowing the right path, and to the extent that you can involve them to think through strategic decisions, ideally you're selecting investors who you respect the opinion of, that you think have pattern recognition that's valuable for you, and scar tissue, and can be objective sounding boards to help you get to the right answer. And I think there's a degree of trust there, which probably means that you don't want the time that you're pitching to be the first time you're getting to know that investor as well. Because if you have good partners and a well-functioning board, then you're the captain of the ship, but you should also be okay being vulnerable and telling them when you don't have the answer. But it's tricky because a lot of boards aren't well functioning, and some partners are unscrupulous or skittish or bad operators. But some of that you can know going in by doing your homework and by being thoughtful about timing, so that you're raising from a position of strength, so that you have options.
Yeah, and Eric and Victoria, when you add, will you just kind of say, does your organization take board seats, and kind of talk a little bit about that?
Sure, happy to jump in. So we are flexible. We often take board seats. We sometimes take observer seats, and then sometimes, especially when we're making a seed investment, we'll take a little bit more of an actively passive role, by which I mean we rely on the company and the CEO to keep us engaged. I would say totally agree with Jason's perspective. I was an entrepreneur before being in investing too, and what Jason said really resonates. Very tactically, I think when an investor-entrepreneur relationship is working its best, the things you can expect as an entrepreneur to get from your investor group, whether they're on your board or not, is help with hiring. So anything to tap network, I've seen that be, a value add. Revenue, so customer introductions, and then you should, ideally be able to use your board and investor group to bring in other investors. Those are sort of the three very tactical places I think value can be added beyond the strategic discussions, et cetera, that Jason outlined. But I agree. Beyond that, it's up to the entrepreneurs to execute their vision and to engage the board as needed, and again, to use the analogy, be the captain of the ship and lead the company forward.
Yeah, I think just building off that, something that Jason mentioned, that I guess it's a rare position for an entrepreneur to find themselves in when they're having tons of funders throw offers at them, but you really need to do your homework at the outset in terms of understanding the motivations, the value add, the different perspectives that funder is going to bring to your table. There are so many different operating models at all of these different venture capital firms in terms of more active, more passive, backseat, helping with syndicates, helping with hiring, helping in a diversity of ways, and it's all over the board. And so it's a bit like dating, and hopefully you're coming from a position of strength, but you really need to go out and meet these people and not kind of jump at the first check that someone's willing to write you. I realize that's kind of it's not a position everyone's going to find themselves in, but you really have to make sure that capital is a good fit. And we see it plenty of times where the capital is not a good fit and things can go wrong, and then a lot of onerous and draconian measures can get put in place, and you lose control in a lot of ways. So I think, and I'm not coming from the operator role, I'm not coming from the entrepreneur role, and so I don't know what it's like to be in that position, but you're giving up a big piece of your business and your life, and you have to be willing to do that for the right group. So take the time to make sure that it's a fit.
And one quick build on that is that if you're not finding many term sheets, for example, there are options. So one option is, to extend your timelines and to say, well, we don't have an institutional investor that I feel really comfortable with right now, and I don't seem to be able to attract the kinds of ones that I want. And so maybe I'm going to take some angel money and buy myself, another year of time and revisit this in 6 months once I hit these milestones. Another one is leverage doesn't just come from multiple options, it comes from having time. And so to the extent that you can find a way to be self-sustainable earlier in your journey, and obviously there are situations where you can't, or kinds of businesses where that's not possible, but it is an argument for standing on your own 2 feet, because like with Runkeeper, when we ultimately got acquired, we didn't have a ton of options, but we had the option of saying no because we were profitable. And it really created a lot more leverage than you would expect. Those are the two points I wanted to chip in.
That's super helpful. And I mentioned this on the last session too. There's a great book called Venture Deals, which helps entrepreneurs kind of understand terms and negotiation and things like this. So I think really understanding how what terms you're signing up to and how all the kind of legal side of things work will be really helpful and super key for entrepreneurs. So I'm going to move to a question from the audience, which is a great reminder. If you have questions, please be chatting them in. This time is for you. I have a few more questions myself, but want to make sure we get everything you guys have answered. So from the Jin, how is your investment process from identification to writing the check? What makes you decide to exit and invest more? Victoria, do you want to lead us off?
Sure, happy to take a stab at that. New companies and new entrepreneurs come into us from multiple ways. Sometimes it's entrepreneurs we've known from other contexts. Sometimes we get a call from earlier stage investors saying, hey, you should take a look at this. Sometimes it's folks we've met just in the ecosystem. Sometimes they're coming out of university labs, and sometimes they're coming out of incubators. So it really depends. But I would say, in the best case scenario, we have kind of built a relationship over time. And then once we're actually evaluating an investment, it's all the things you would expect. So we start with an initial call, initial pitch. If that piques our interest for all the team and market and regulatory and all the reasons that we think at first blush, then we dig in a little bit further. So what that looks like depends on the company. If the technology is core to the investment, we spend more time there, sometimes bringing in experts where our expertise ends to help us evaluate the technology. Similarly, on the regulatory side, we will make investments where regulatory aspects come into play, particularly in the energy space. So similarly, we will use our own network to source information and get folks' reactions to our questions. We spend a lot of time with the company. So beyond that first meeting, we sometimes have 4, 5, 6, sometimes more conversations with the CEO and almost always with more of the team. Back to the team. It's really important not just to meet the CEO, but the full co-founder set. And the more time that we can spend with the broader group, the more helpful we can be and more comfortable we can get. In terms of the specific process beyond initial diligence, again, it depends on the company. But after we work in a single partner or sometimes a double partner strategy, but we're always trying to engage with our partnership to get multiple viewpoints on a company as we go through diligence. So it's common for us to discuss a company 2 or 3 times as a group before one partner, who's the lead partner, gets conviction to make the investment. And then at that point, assuming we've gotten comfortable, again, with the degree of risk and the milestones and the amount being raised, we're often involved in pulling together a syndicate if we're leading or if we're not leading, we are pulled in from somebody else or otherwise helping to round out the group. Again, to the earlier discussion, really important to have a group of folks around the table who are committed for the long term, who you know are going to be helpful, be great partners when times get tough and when times are great. So that part takes place a little bit later in the process. And then if we're leading the deal, then the last step is, after having done all the diligence, talked to customers, done reference checks on the team themselves, then we get to the point of deciding on terms and valuation. And that's also an iterative process, looking at kind of traction, looking at benchmarks in the marketplace. A lot of different factors go into the actual valuation and terms decision. But our own perspective, and I think this is true for many investors, especially at the early stage, we try to keep things straightforward and clean. I think sometimes if you're seeing that early stage that investors are putting in onerous terms, that's a red flag, not only for the potential partnership, but also it's a signaling mechanism for subsequent rounds where additional investors will be looking at that as, what went wrong here. So at that point, it's, an iterative negotiation process. And then if we get it over the line, we move forward with truly being on the same side of the table and joining the team in many respects.
Yeah, curious from kind of the foundation landscape and the angel relationship, how your process is the same or different than Prelude's. So Eric, do you want to talk a little bit about your perspective?
Yeah, absolutely. I don't think it's not too different, but I think the level of complexity changes based on who's sitting around the table. So you'll hear this as syndicates formed, people tend to do a bit of cheating on their homework and tend to rely more on who's sitting at the table with them. And as a small team with limited resources, I'm totally guilty of that. And if we have funding partners that I have high conviction in, that really helps us get over the line. And maybe we won't do the same level of diligence that we normally would have if it was earlier in the development curve or funding cycle. But when it's a deal in the pre-seed, seed, Series A, and I'm either leading that deal or being a significant check, we are doing that whole process and going through and making sure that we're checking all of those boxes. And just to what Victoria said, we're spending a lot of time together. There might be multiple visits, and I realize this is all changing during COVID, but spending time together and getting a feel for each other is probably the most important part of the process. And so just talking about beyond what drives you and even aspects of your personal life, I'm getting to know who you are as a human. And so that's a big part of our process as well.
Jason, anything kind of from your perspective that is different?
Well, I just have less process and move a lot more quickly. Given my situation, writing a lot smaller checks as an individual with no one to answer to or fiduciary responsibility for anyone else's capital. I am trying to grow up and build the muscles of a professional investor, though. So the deal I syndicated and took a larger allocation in a couple weeks ago. I did. That was the first investment memo I had ever written, or actually, my chief of staff did for MCJ did a lot of the writing. But I think that was a really good, healthy exercise to go through to try to start to build those muscles and that discipline. Because ultimately, I would like to be leading these deals. So although my small check is certainly not going to be doing that in the position I'm in today, I'm trying to act as if and learn how to think like an Eric or Victoria. It's kind of in flux, but as an angel, it's a lot more flexible, especially because I think typically when I do participate, it's because there's an institutional investor leading the deal who I have an existing relationship and trust with, who is bringing it to me and asking me to be involved because they think my little check will be strategic because of the domain. But in a world where I was leading, it would look a lot different.
Yep, that makes
The only
sense.
I would add to that, Hannah, too, is the frame of reference really changes pre-revenue versus revenue. The metrics and the measurement really shifts when you're thinking about, yes, you've already established some type of product market fit, you've demonstrated traction, you have customers. The investment underwriting process really takes a whole different lens for us versus pre-revenue. Maybe it's on a napkin, probably not going to go that early, but you don't have that fit determined yet. So that's one thing I'd keep in mind as you move throughout that curve.
Does that?
The only other.
Oh, sorry. I was
Sorry,
just going to
Hannah.
ask a quick follow-up for Eric of when he says it changes, like how does it change? What should the entrepreneur know there?
Yeah, it's changing how we value and understand the business because maybe we're spending more time talking to customers and understanding how that product or service is being received in the market. And that's really what's driving our assumptions on growth because it's going to change how we price and how we think about the future upside of this business opportunity. And we do that pre-revenue, but it has a different lens because maybe you're going through those technical or regulatory hurdles, but before you have a product in the market.
I was just going to add from the entrepreneur's perspective, this is a diligence process for entrepreneurs too. And there are lots of ways to do that. But one very specific way that I think is useful, and we sometimes offer it up to entrepreneurs if they don't ask, but is to talk to other entrepreneurs who we've invested in. And, I'm sometimes surprised that entrepreneurs don't do a little bit more digging. Backdoor references and front door are really telling. So would encourage folks to use the time while you're being grilled to do some research in the other direction as well.
And the only other thing I would add from an entrepreneur's perspective is, although they call it a pitch, I really hate that term. I think that it is. I think that you can get signals if an investor is leaning in, and you can put out things to test if they're leaning in. But if you're not getting those signals, just spend your time elsewhere and then do things that get them to lean in. But you want to be courted, and either you're chasing or you're being chased, and there's not much in the middle. So to the extent that you can put yourself in the position of strength, there's some psychology involved. There's some timing involved. There's of course execution, but you just want to be strategic about putting yourself in a position of strength. And so the more you control the process, the more leverage you can create. That's not very specific, but it's kind of a game, whether investors want to admit it or not.
Yep, that makes sense. And that's super helpful, and just kind of around thinking about leverage, negotiation, and kind of the essentially emotional intelligence of the people skills between the founders and the investors and everything. Real quick on this topic from Alex, how long does it typically take each of you kind of from that process you just described, if you have an average time frame?
It's all over the board. It can be really a short process depending on, again, who's at the table or what size portion we want to take and how interested we are versus a long-term relationship. And Jason really keyed on this of coming from a position of strength. I mean, take the time and go through it when it's right and build relationships early. And maybe you're starting to build that relationship and you're thinking about 6 months of courting essentially before you're kind of ready to execute on a round. And so having position to kind of intake inbound VC interest or reach out and network way before raising capital is a really good thing because you're essentially starting the diligence when the relationship starts. So it's all over the board.
Yeah, and to the question about how to accelerate the process, one is to have all your materials together and clean, and I like to be surgical about the process of like either have an on switch or an off switch. Like don't go halfway. Just be thoughtful about when you do it, and when you do it, make it your full-time job until it's done. But well time it so that you're in a position where you actually have the goods to get it done. But the other thing is, if you want to accelerate the process, then have someone who's interested think that the deal is going away because you're going in another direction, and don't fake it. Just have options.
Yep. Anything to add, Victoria?
Yeah, the only other thing I would add is, to the point about how do you create leverage for yourself and how do you create a sense of urgency. I think it's okay for entrepreneurs in an appropriate way to ask up front or in the middle of the process what to expect. And I think sometimes you'll get a direct answer and sometimes you won't, which tells you something. But B, especially, we haven't said the word yet, but I'll break the silence. In the era of COVID, I think it's fine to say, to investors, how have things changed? Help me understand, expectations on timeline. I know, different firms have different approaches of how they're investing right now, but I think, without being annoying about it of like, what exactly is your process? Because you just don't know. I mean, the reality is when you start diligence, you can have the diligence plan, but ultimately you learn things along the way that kind of take you in different directions. You just don't know. But I think effectively communicating, with queues and having other processes, other groups in process can help you have a conversation around, this is what my timeline is. Does that fit within, your normal investment process?
Yep, and that's great segue in our last question from Michael. Says, I read that the investment deal flow could fall by around 50% this year. What is your view on the economic situation, and how do you see it impacting your fund or investments in sustainability-focused startups in general? Is the bar for investment set higher in a recession? So yeah, using this last kind of few minutes or 5 or so minutes to talk about how your expectations maybe has changed given the current market, and any thoughts there?
I'm happy to take a first stab. So we are still planning on making investments. We have not yet done one since the shelter-in-place order was put in place. We closed things that were already in process. But we haven't run a full process within the shelter-in-place order. We want to. I had 3 conversations last week with first-time conversations with new companies, and moving forward in diligence on at least one of them. That being said, we're still trying to figure out exactly what it looks like to spend the normal amount of time that we spend with a company. And I've tried to be transparent with people, with entrepreneurs about that. But a couple of kind of macro thoughts. One, especially at the early stage, great companies and great founding teams didn't disappear overnight. Is sort of our perspective. Is there a little bit extra diligence around, are you clear on your runway? Do you have enough? Are you raising enough money to get you through what may be a little bit of a funding trough for the next 12 to 18 months? So there's certainly, an extra layer, and some companies have more or less impact from both the COVID situation and the ensuing macroeconomic impact. But from our perspective, very much still looking to make investments. One of the things to be transparent, we're thinking about is, does it make sense to go a little bit earlier? So rather than focusing on, A and B, will we do a little bit more, A, or maybe a little bit more seed deals than we had otherwise? It really just depends, but we're still excited. And then the other comment I would make, which is one that you'll probably hear batted around, but if you look at funds with vintage years in recessionary periods, they're often higher performing than others. There's a little bit of valuation reset and other factors that go into it. But I think, we're in a new world. There's no doubt about it. And there will be changes in processes. And like I said, a couple more diligence items that may be added to the list. But I'm hopeful. And then the last thing I'll say on this is the climate crisis hasn't gone away. So we don't have a choice but to continue to deal with it. So happy to hear what others say.
Yeah, I can jump in there. I think it has definitely changed some of our perspective. For those who have heard of Jeremy Grantham's name prior to this, he's kind of one of the most famous value investors in the market. So from that perspective, it is a buyer's market. We do expect to see prices changing quite a bit, be it discounts or just the cream rising to the top, so to speak, in their hunt for capital. So from there being kind of less people out there searching for money, we think there'll be higher quality people searching for money, and there'll be better expectations on the need and alignment of that capital and working with those who are rising through this crisis. I think, as Victoria mentioned, we're in remote diligence on 2 to 3 deals right now, and I think I can get comfortable with a lot of the process, but we're still debating on whether or not we would close on a full remote-based deal without having spent time in person. So that's an ongoing dialogue. But I do think personally that we're going to come out of this, by sometime this summer, and I think the infection rates are much higher than we think they are, and which means the mortality rate is much lower than we think it is. And so by no means will we be just getting back to normal, but I think there will be a time and a place when a lot of great conversations and great ideas that are happening now are going to get pulled through this at-home work into a real meaningful relationship type category. And so we are still very much actively looking for opportunities.
The only two things I would add, one is I would just be optimizing for time. And so one way to have time is to have capital. Another way to have time is to keep your burn real low and find non-traditional ways to keep putting one foot in front of the other. When Runkeeper started, it was 2008, a few months before the bottom fell out on the market, and I was the only one full-time with a team of moonlighters and paid them in equity, which meant that our burn was artificially low, but we had other than I had some personal savings squirreled away, so we had indefinite time, which meant that we could cockroach and keep putting one foot in front of the other, which in that time put us in a competitive advantage. Whereas if the market was operating normally, we would have gotten laughed by people that went out and raised capital the more traditional way. So I think a lot of companies are going to go away, unfortunately, that are good companies that fell victim to, this arbitrary, some companies are getting artificially inflated because of the pandemic, and a lot of really good companies are going away that didn't do anything wrong. It's just unfortunate. And if I were a professional investor, which I'm not, I think I would largely be just waiting it out, trying to get a better handle on how we're going to come out of this. And if you are in a position where you need to talk to them the same way we were talking before about explaining the risks and being open and honest about how you're thinking about it and what one would need to believe to get excited about this, put yourself in that investor's shoes and walk them through your thinking around how you think you can navigate out the other side and what one has to believe about the world and about your company in order to think that you have a reasonable amount of time and buffer and the ability to execute and create value in a post-COVID world. Yeah, but it's going to be really
super
hard.
helpful.
Yeah.
Well, we're at time, and I'm just so grateful for all three of you for joining us for this hour. I mean, I learned a lot. I hope everyone listening did too. Really appreciate all the work you're doing in the world and your fighting the good fight around climate. Thank you again.